economic growth in sub-Saharan Africa is likely to slow down to just 3% this year. Now, that is not only lower than 2015's figure of 3.4% on average, but it's also the lowest level since 1999. In its latest economic outlook for the region, the IMF said growth will lose momentum due to a range of factors, among them the decline in commodity prices, the Ebola outbreak and its aftershocks, and the worst drought we've seen in this region in decades. Now, growth may recover slightly to 4% next year, helped by a slight recovery in commodity prices. The top two oil exporters, Angola and Nigeria, have been hardest hit by the decline in commodity prices. No surprises there. Guinea, Liberia and Sierra Leone are gradually recovering from the Ebola epidemic, but not fast enough. Several southern and eastern African countries are suffering from a severe drought as well. Let's get the latest review of these numbers. Daniel Rangers is live in Washington tonight with more data on the story. Daniel, the fund pointed out that the stimulus effect expected from lower oil prices was a lot smaller than forecast. Was that mainly due to the stronger dollar, or are there other regional factors at play?
Well, certainly some of the currency depreciations we've seen has had an impact. But as you were alluding to, some of the impacts on non-commodity countries are related to regional factors such as the drought in South and Eastern Africa. You have the continuing impact of the Ebola epidemic on Sierra Leone, Guinea, Liberia. And then at the same time, you know, many of these countries, at least half of them, are in some way exposed to commodity prices. So not as acute as some of the major oil exporters, but certainly still it has an impact, especially those ones, for example, that have quite a lot of their earnings from minerals, mining, that sort of thing.
Indeed. The IMF has also called for a policy reset, which seems to include its usual cocktail of fiscal consolidation. You see that in its reports pretty much year in, year out. But are there other policy ideas here as well?
Well, I think the IMF's trying to be a little bit more creative than its usual cocktail, as you say, of fiscal consolidation, although obviously it remains an important part of the way in which these countries begin to adapt, given that their earnings have fallen down so much. But there are other things that they are recommending. For example, greater exchange rate flexibility. Basically, if you are pegged to a currency like the euro or the dollar, it limits your capacity to lower the value of your currency and then compete with the world stage. So in other words, when you have a flexible currency, it acts as a sort of shock absorber to your economy. And certainly we've seen that in South Africa, where South Africa has become much more competitive on the global stage in some of its trade areas. Another thing that they're recommending is further enhancement in the financial sector. Looking at the case study of the way in which mobile money, for example, has been very effective at providing a stimulus, internal stimulus in some of these African countries, and also the rise of pan-African banks, creating some demand there. And lastly, the area of infrastructure, public works, improving the quality and effectiveness of those investments, particularly aimed at trying to diversify their economies.